Well, that was one of the worst starts that we've ever seen to any trading month since 2020. So what gives for us as we enter into September, well known to be historically the worst month of the year, with the $1 trillion being wiped off markets, NVDA entering into a potential antitrust, and manufacturing data coming in weak? Even the oil markets weren't very happy, getting crushed below the key demand zones we've been discussing recently. But a lot of it might come back to price action, with gap fills happening on the Qs and NVIDIA entering to the second level that we've been talking about recently. Will we see a bounce from the bulls, or is this the beginning of an absolute collapse in the AI tech stocks? One thing's for sure, the S&P 500 will probably hold the key. In today's video, we'll talk about the confluence of all these levels, along with the biggest transactions going on in stocks, commodities, and cryptos. It's not to be missed. Let's get into it right now together. Well, welcome back everybody to the Daily Show, where we talk about the latest macro data and flows going on in the markets. And boy, oh boy, were there some massive transactions over the last couple of sessions we need to discuss. Big one, though, was, of course, NVIDIA. If it's your first time here, then why not subscribe, especially if you love markets, whether they're stocks, commodities, or cryptos. We do them daily here. Let's talk about NVIDIA, though, because, of course, the news was front-run by price action. Loose lips were out in the markets, and it's kind of frustrating when you see this unless you already had some of the key levels that were given. Over on X, I posted that NVIDIA had no demand in sight during the session, and that's because, of course, we knew that 106 was the next major level. We'll talk about that later on today's show. NVIDIA gets DOJ subpoena in escalating antitrust probe. Yes, what's happening to Google now seems to be happening to AI stocks, and it caused semiconductors to have the biggest percentage drop since March of 2020. Now, it turns out that when we've had these big sell-offs in the major markets, in particular this one, which is the start of the month, the last time we saw this was May 1st of 2020, and the S&P fell 2.81% versus 2.4% over the last session. Following this point, S&P was up, of course, 3.5% over the next week and 7.95% over the next 4 weeks. Now, you may say, well, liquidity was being pumped into the markets at those times. Of course, the Fed was panicking and we were in a much worse situation that ended up, of course, getting juiced by the biggest central banks in the world. But I still want to put some things in perspective before we go through the bull and the bear case scenario. Number one, have we seen many big S&P 500 days this year? Not really. We've only actually seen 3 2% plus days over 2024, and that's underneath what we've seen in previous big sell-off years. Take 2018 or 2022, for example, 15 and 10 respectively. S&P 500 large numbers of large up versus down days. Remember, 2024 is still net way more bullish than bearish when it comes to these percentage moves. And we also know that the annual performance, therefore, really does come back to the S&P 500 doing relatively well. You can see that when we have a lot of these up ranges and less down over 1% ranges, we tend to be more in the vicinity between 10 and 20% over the year when it comes to S&P 500 performance. Now, these are just data and statistical facts. When you start the year pretty well, you tend to end the year pretty well. But September is the worst month of the year. So could we be getting into more volatility? Could we be getting that pre-election kind of vol that we know the markets have been looking at ever since realistically July? Well, the Magnificent Seven is not where it seems like the market's at anymore. We've been talking about this for quite a few months, and we're seeing an outperformance now in the other 493 stocks. This is actually a source here from Charles Schwab, basically saying that they're also seeing flows that are going into everything else. No surprise, price action has already shown us this with RSP and IWM and some other sectors of the markets doing very well. In particular, financials, utilities, and even staples. Now, when we see these types of things, including healthcare, we know that we're probably coming into what we call late cycle investing. And this is where we need to consider all of our situation. So, of course, the ISM manufacturing PMI came out. Some of you may remember this was the news that front ran, of course, that massive crash in the yen and the Nikkei only a month ago. And this was, I think, a little bit of an overreaction to this news. Now, of course, this was probably not the main reason why we ended up selling off. Now, it's not a great number. It's quite weak. And of course, it's one bad read for the US. But as we posted over on X, the thing about bull markets is they love a kind of weak economy. And you might say, why is that? Well, because remember, central banks and of course governments around the world do everything they can to stimulate them. And that's exactly what the market expects right now. And it's why we're sitting where we are. And of course, this is something that you need to keep in the back of your mind. Are we in an incredibly weak market that's going into recession? Well, we have the stats on that in a moment. Or are we in a market that's still kind of growing, but it's growing at a very slow rate, mostly due to, of course, unfair predicaments caused by the Fed, where they come in and they say, oh, here's some liquidity, here's some other things. There's a chart coming up soon that will absolutely blow your mind if you're not familiar with it when you look at the liquidity in the markets at this stage. Let's talk about US 500 though, because it's coming into a key level. We'll go through this in just a few moments, but just a reminder, we post this over on our X account. So follow in the links in the description down below if you're interested, because this is a fairly interesting confluence zone. We've got anchored VWAP, we've got the options low level, which is being updated for today. And of course, we've got the gap fill zone and a fairly large trade range area. All of these things point to a very good level for us to have patience and then see a reaction off these zones where, of course, bulls may come back in. So what are the reasons why we fell? Well, of course, the antitrust isn't good. We'll go through that soon. But also sentiment was incredibly bullish. We know the bull-bear spread ended up going all the way back up to almost 30% after dropping into the August period. So this is something that's important, but we do need to remember there's still a little bit of room here for CTAs and other buyers to come back in. Some people are suggesting that, of course, Wall Street are back from the Hamptons and they're ready to create a bit of vol so they can get some nice cheap prices and then, of course, resume their bull run on markets. Here's an interesting one. Recession probabilities from Goldman Sachs. They believe it's at a 20% chance that the US enters a recession over the next 12 months. And the market itself is pricing in actually quite highly here, supposedly a 38% chance of a recession occurring. Now, you may notice when we saw a previous recession, it's not usually when the market thinks the recession's coming. It's the calm before the storm that you need to be more worried about. And this is something that I'm looking for in the future. Now, are we already in a recession? Well, some people argue that. Some people argue we're in a recession since 2022 and they changed the wording behind it. But I always look at market structure, which of course we do here on the channel, and also to see whether there are weak areas of the market. And right now, we're just not seeing that type of thing. We can also see here from Goldman Sachs that it looks like the NASDAQ 100 models in terms of trend followers, which of course are CTA positionings, in most cases, they're going to have to start buying further into this market. So again, there's a chance here that this is more of a flash sell that's causing the CTAs, or at least allowing these CTAs to get back in at cheaper prices at possibly the expense of us, the retail traders. Let's take a look at this chart, and I posted this over on X, a great one for you to bookmark. And what it is it's global liquidity index. And you can see here how well the markets have actually followed these liquidity indexes over time. We saw a huge increase in liquidity as the Federal Reserve did some cutting, of course, of interest rates back in 18 into 19. And that then, of course, came into the period where we saw that massive crash in 2020. We saw a lot more liquidity getting injected into the market, which then dropped out into a 2022 drop. And then, of course, around October of 22, we started to see liquidity spike back up again. So we're done with tapering. We're done with liquidity being restrictive. And now we're in a market where central banks are most likely juicing these things to slowly eke out what we call a deflationary boom. Basically, it's a market that's not that great, but it's not that bad either. And you do need to put in perspective different bull market checklists that, of course, are used pretty heavily by the industry. In this case, of course, we've got the bull market behavior checklist. And you'll notice here that all of those are still mostly reading towards the bull end. There are also some interesting stats here when we take a look at how we've entered into September. If you have a run from January to September, that's 7 months of overall bullishness, it does tend to lead in to a very good gain on markets. In fact, 91.67% of the time we get a probability of gain, and only 8.33% do we get a probability of loss. So that's a pretty interesting return considering the mean return is 5.29%. Now you'll notice that this is important. When markets come into certain periods of time and they're structuring in well, that is something we need to consider. We're also seeing corporates now borrowing at cheaper rates, and they're taking advantage of it. There's a lot in particular, there's a lot of liquidity that we'll talk about in the future, so make sure to subscribe, that's actually slated for late 2025 and 2026, where we're going to see companies with bad credit actually having to refinance. I think that's a massive problem that we need to discuss, because late 25, 26 is going to be horrendous. But a lot of corporations are now borrowing at cheaper rates. This is something they are doing. Remember, we do have other news coming this week. It wasn't just the manufacturing data that came out. We've also got that non-farms, the fake jobs numbers coming out. And we'll find out whether we get Goldman Sachs consensus of 155K or whether we get more or less. Remember, it doesn't really matter about this number. It matters about what the market pushes the markets towards. Do we hit some kind of liquidity trap? Remember, sometimes with non-farms, the first half an hour to 1 hour can be a false move, and then it goes off in the opposite direction. A very common thing. Oil plummeting to new lows obviously shows that demand may not be there, could show a slowing economy. Again, shows that probably central banks do need to juice this economy, which is what they're trying to do. And then we enter into this, one of the most important charts for us all to be looking at. What does the market do post, and this is very important, post, of course, the Fed cutting cycle? Now, we know that in actually a non-recessionary period, remember that's this kind of like reddy kind of color here, we usually see, as we're entering into the rate cut itself, some weird turbulence of the market. The market will often stay sideways, so it'll stay coiled all over the place. Then it will drop after the actual rate cut itself, and then it will rally through. Now, funnily enough, the market is actually doing everything that we've seen here. It's dropped pretty heavily, often considered some kind of weird flash that goes on. It's rallied, which it did, of course, over the last couple of weeks, and now it's dropping again here just before the announcement of the first Fed rate cut. Remember, the big key here is that we only want to see, if you're a bull, a 25 basis point cut. If you're a bear, you want 50 basis points. If you get a 50 basis point cut, you'll be celebrating, because that means the Fed is panicking. And if they're panicking, it can lead on to, of course, these two major drops in 2001 and 2007. We've talked about these stats enough times. Check out our weekend video if you want to go through some of that data. But just a couple of interesting things here. The Euro area economic surprise actually went up again. So we're seeing actually some interesting Euro area growth here. And sometimes that front runs the rest of the world, if you can believe it. So yes, we're seeing economic surprise again. Global surprise, of course, is down. So some positive signs coming out there as well. Now let's move over to a couple of other markets. First up, before we go through the dark pool liquidity, which is probably the most important right now, I would say, is Bitcoin versus the moving averages. You can see here that it's not doing so well versus most moving averages. Of course, it is quite far under some of them, which I guess is quite important to think about, and the slope is negative. Now, Bitcoin's in a zone that I think is very interesting. In fact, I'm moving into more and more bullish on Bitcoin, even though the trend is completely down, because I think that it is a decent pickup alongside, of course, our favorite asset at the moment, which has been gold all year, because we're in late cycle. And we'll explain that more in upcoming videos, so make sure to subscribe for that. In terms of how S&P 500 is performing, generally September, the first half is better than the second half. If the first half's bad, could the second half be even worse? Well, it's possible, but do remember we have other stats on the horizon in terms of if you have a 3, 6, and 12-month horizon. When we think about this, we had a 70 Brett thrust. We had a Whaley Brett thrust only about a month ago. And then, of course, we've had this one here, which is a fairly rare read, which is a fairly decent breadth signal. Now, you'll notice that you get these signals, then the market just gets crunched the next session or even the next week. That's not unusual. In fact, when you get these types of reads, you can see here a couple of nasty periods over the next 2 weeks. But overall, the stats of the next 6 months and 12 months do tend to be quite bullish. So we have to, of course, see this evolving situation, but these are longer term reads. So 90% of the time, 1 year later after these reads, we were up, and we weren't up just a little bit, we were up pretty big. So this is something to keep in mind when you're looking at these markets. Even Labor Day to the end of the year performance tends to be statistically bullish. Keep this in mind when you're looking at the S&P 500. You might say this time's different, but maybe the dark pools show us it isn't. Have a look at some of these reads here. This is one that's a bit wild. After hours, iShares Russell. You'll notice here we get these huge kind of transactions going on off that rejection wick. So big transactions coming into the Russell. That's pushed it down, of course, and the market started to sell off. We also saw big S&P 500 overall pool kind of shows here coming through on the Friday, and the market, of course, has sold off since then, getting close to the gap fill. These are fairly large transactions. And then we got some big ones, of course, coming through the SPY and even Qs. But I think the most important one here could be what just happened over the last 24 hours. This is right into the close. We saw an SPXL, which is a S&P 500 3X fund, show a couple of massive dark pool prints. Now, in after hours action, we've actually got the markets even lower, getting close to the gap fill. But if they regain this price, if they regain back above whatever this code is, about 147, we'll look at that in the S&P in a moment, that could be a huge tell that someone actually has been buying this dip that they're causing here on the Tuesday, on the shortened week. And remember, yes, jobs numbers are coming, which might scare us, but could this be front-running the expectation of volatility into the jobs numbers? Two monster transactions, two huge prints coming in on a 3X fund. I also think it's interesting to note that the S&P 500 is now performing worse than gold for the year. And this is something that we don't see very often. Now, most people say, and of course, a lot of people in the comment section say, Tom, gold and silver suck, man. The lost decade with the worst returns. People lost tons of money being in these. Remember, gold and silver are currencies. And well, silver's a little bit less of a currency, but gold particularly is a currency. You have to know when to hold it and know when to drop it. And this year, we're particularly bullish on gold. Of course, I've talked about $3,000 an ounce. That might be even undershooting where I think gold could get to based on this current late cycle concept here. But you do need to remember that this is important. When gold starts to outperform the S&P, that's a very, very interesting time to be in gold, to be in these particular asset classes, because it shows you that late cycle. It shows you that people are concerned about debt in the markets. And for someone that's bearish and knows a little bit too much about the markets, you know what they say, sometimes a little bit too much information is dangerous. And then until you get like a full understanding of cyclical theory, well, yeah, it is certainly a very interesting time to be in those assets. So let's take a look at the sectors now for the markets. And again, these are not really the types of sectors that you would expect to be up if the market was in a systemic crash. We've got financials, and then of course we've got defensives along with REITs. Utilities and healthcare, they're ones that should do well right now. Financials, well, of course, debt is being written and liquidity is starting to increase. So, of course, that is also a decent sign for the markets to continue their bull trend after whatever happens here in AI. But AI is concerning, down 7.16% over the last couple of sessions, and in particular, lost it all pretty much over the last 24 hours. You can see here the defensive nature of the markets in terms of sectors, and semiconductors losing 7.5%. So let's have a look at the S&P 500, then go through some options flows, and of course, go through those particular stocks. First up, advanced decline line was down. No surprises there. The markets are down further in after hours trade, which is probably no real surprise. Getting towards the gap fill makes the most amount of sense right now. And we were unable to break through this high. Now, I thought that if we could get through, I think it was 56.60, 56.75, that we were in a positive gamma situation at that point that would start to push this market through. But it couldn't find any bid whatsoever. It opened down. It opened around like kind of a relatively heavy trade area throughout this range, and then just sold and sold and sold and sold. And you will see there was almost no bid. There were basically no bids for the session. And if you're a member of our private community, or if you're a member of course, one of our courses, you would know that we often say patience, react, don't predict. I didn't mind this level down here, actually. I thought that it was a key zone for the market. So there was quite a lot of compliments there. But there was just no bid. And when we don't see a bid, you cannot buy that area. You just can't do it unless you're going to use some type of multi-day option. And it just kept going to a series of lower highs and lower lows for the entirety of the session. So this is a bit of a problem. And of course, we didn't see any structure up. But let's have a look at the futures market, because there are some confluence points coming up along with some oversold signals. You'll notice I've got a little apple here. That's showing you that on the smaller timeframes, this market has probably oversold itself. But we're not quite at that gap fill zone, 54, 55 kind of area, the options low level, the anchored VWAP, the trade range zone. Anything in this area here is where I'd be looking for structure base. The bears, yes, they're powerful right now. Yes, they've pushed it down. But this area here is still, I think, going to have quite a lot of Wall Street buyers. So let's have a look over to the options market, because, of course, this is one of the most important levels. Now, we've just talked about the idea that 54.50, this area here, might be kind of where the buyers try to come back in. Now you can see why that could be, because look at these puts. All of a sudden the calls have evaporated and there are puts everywhere. People instantly buy puts in this market nowadays. Have a look here at the 4th of September. We're expecting just around 5,500, 54.95. That's a big put wall now. And we're moving into negative gamma on the open. So if the markets can't rally, of course, it can create a waterfall systemic effect. But if you look over to the next session, all of a sudden we're sitting at 55.10, 5,500. Now these options walls, they are a bit of an indicator here, even if you go through here to the end of the week where we've got the 54.50, that we're coming into a key level of demand. Why could I say that? Well, because there's so many options here. We've got big puts sitting on the day, we've got big puts sitting on the next session, and then of course we've got big puts sitting on Friday as well, which all suggest that market structure, considering the confluence, could build around here. And it's a very important point for markets. Being in a gap fill zone, you'd want to see buyers come in here to really sustain, I guess, what we've seen so far, which has been a fairly healthy, big, strong recovery in the broadening of the market. Let's have a look at the CTAs. Goldman Sachs already believes CTAs are going to have to purchase this week. We can see here how far they are behind where they were previously at the highs and the previous highs over here. These funds are actually down for the year. They're not doing very well. So CTAs for both the NASDAQ and the S&P, they've got room to go up. Meanwhile, on the oil side, doesn't look so good. Of course, they're kind of like neutral down. The silver side's actually horrendous. They're actually dropping it like a rock. And same with gold. So it's interesting to see them dropping, yet the sustained demand of these metals, in particular gold, is still so strong. Could that just be that realistically countries are just buying it? Of course, we know Russia, we know India, we know China, BRICS countries in particular have been buying gold out of control. Seems to be holding up, including the retail traders buying it. Let's move over to NVIDIA and see if we can get any ideas about put walls or potential demand levels for this most important stock. Now, I will say that the antitrust, it could really dampen the mood on NVIDIA and stop it from having such strong, robust recoveries. It is a concern. I still think it's a great stock. I hate antitrust. Of course, it's very bad when it comes to investments, getting great returns out of it. We've seen Google struggle since, of course, that came out in the news. Now, 110 is an important level. So, of course, holding on to 110 will be big. 105 we can see here. And you would have to suspect that 100 in particular would act as a massive put wall for NVIDIA this time around. Do I think it's going back to 92s? That's possible, but considering the antitrust, but realistically, I think one of these three levels should hold it up, and we're looking for some structure build here. So I'd be looking for some bid to come back in on this key market, and in particular, you'd want to be timing it with that S&P 500. That's the beauty of the S&P. Gives you that overarching market sentiment. Then you go and find the stocks that matter to you. Now, I did post over on X as well that Tesla was in a positive gamma situation. Well, it was, and it held up really well. Tesla did really well for the session considering everything else. We actually we were above 215 at one point. If we'd hold that zone, you can see here 215 is such a heavy strike. So at the moment, it's acting as resistance, but if the market's able to gain it, as we know, positive gamma takes hold and the markets have to hedge it off. So that's going to be a very interesting point for Tesla traders this week. Let's take a look at the broad market. How's it going? Still showing signs of late cycle. XLY versus XLP shows that the market is kind of defensive in nature. That's pretty normal to see around this time. And we continue to monitor that situation. We're also very close to uninversion of yield curve. We'll do a special on that in our next coming videos so you can see what happens after uninversion of yield curve. We've got the data to share. And the US dollar here, you'll notice, is back at that kind of key resistance area. So pretty much working a perfect leg at the moment. Remember, each one of these legs has been equal. We've got here the first leg, the second leg, the third leg, a little bit of an overshoot, great pullback zone. If that was to continue, it's interesting. It would actually take us underneath parity. The dollar is in a precarious situation. I would say the dollar is overall weak. But of course, we've been strong into this level. I'd call it neutral here. Neutral to show and look for the signs of bearish action if it can come through. US oil, oh, what a catastrophe. We did talk about the idea that this was so bad on the weekly that you just could not buy that big demand zone. This is why when a demand zone is multiple times tested, remember we've used it here and here to find buys before, we could not like it over here very much. even the little rally we did see was short-lived and it got crushed down. I'd be looking for a lot more news to come out on oil. There are key levels. I've got to watch reaction here for a scalper kind of person at 66.90 a barrel, but this is politically charged, so be careful on oil. Of course, certain people want it down and certain people want it up. It's a politically charged commodity at this time of the year, coming into one of the most important US elections we've ever seen. All right, let's move over to gold. And what's going on here when it comes to gold? Well, it's holding up damn well. CTAs might be dumping it, but people are still buying this. And I think if gold can reclaim above 25.08, that's a good sign to show that maybe this pullback that we knew we had to have based on our stop sign kind of here on the indicator was maybe over. For now, it's at a key level of demand, but it hasn't shown that really serious level of momentum to get off this level and to go make new all-time highs. Now, silver, on the other hand, came down to our most traded zone. I actually quite like this level for silver. So silver's been very strong. It's managed to get through a few areas. We, of course, talked about 26. It fell off after hitting this first TP, and it's back down here, as you can see on the 61.8 fib and the level of demand. Very important point for silver, and we have started to see some structure. Now, it held while the rest of the market was dumping off later on in the session. You'll notice here we're not certainly above 28.60 or any of those key levels, but if we start going down into the smaller structure, you can see a little bit of bid coming in. So I think like a 3-minute, 5-minute chart trader might have liked it at 27.80. They may put stops underneath 27.60. It's a bit of a low percentage play, but of course I still think it would be better than a coin flip. And we'll see whether this market can actually find structure. For most swing traders, they're going to be looking to reclaim 28.80 plus and then start to think about getting back in on silver. Copper, it looks frankly pretty terrible. Some people could say it's an inverse head and shoulders build. I'm not really thinking anything. I'm going to go neutral on copper. I'm watching iron ore very closely. We'll keep tracking that. Iron ore will show us probably front running of China and the stocks there. But at the moment, they're all neutral to even down at this situation and time period. Tesla, pretty good hold. 210, not too bad. Good news coming out of China, of course, and they've announced, I believe, a 6-seater, or at least it's expected a 6-seater Model Y, all sorts of things like this. Bad 2-hour rejection, of course, coming off this gap fill here, which is at 220, but we all know what's happening. If it goes above 215 and can hold it, that's that positive gamma situation. And actually, small structure has turned to the upside now rather than the downside. It'd be interesting to see whether Tesla can hold this level. What about NVIDIA? Well, it went to 105, 106 after hours, hit the most traded zone. This is a key point for NVIDIA. For long-term hodlers, maybe you like this zone. It's pretty good on the charts in terms of it's a key level. Of course, we had 2 key levels, 115 and this level here. And really, if you bought in between here and here, it's no real point. Like anything in here, just basically giving the street money. Remember, markets move from equilibrium level to equilibrium level. That's what we talk about here. It's what I talk about in my courses, particularly the day trading and the advanced class. That in itself saves you a ton of money because you must think about markets moving from structure zone to structure zone. Where are the biggest traders? Where are these big volumes coming through? If you're not using volume profile on your charts, you better start using it. We do it here. I just, of course, put it in as lines. So let's have a look because otherwise it gets really ugly for you guys when you're viewing it. HSI, let's have a look at this one. So this is Chinese market, one of the markets there. It's holding okay. Considering the sell-off in the rest of the broad worldwide markets, not too bad. Found a little bit of bid here today. Like to see it, of course. Fine, close there, maybe move on the way up. Semiconductors, looks bad, eh? Pretty bad. 61.8 fib, similar to, of course, NVIDIA. We got these kind of stop signs. Wait, halt, stop. We knew there was an issue there. It's giving up some of these gains. Like what we saw on NVIDIA, we've basically seen it come back down after hours to the 61.8 on the upside now. So this is a very pivotal point. I'm going to be interested in the bid here. Wait for the next video. Let's see how it bids through. Watch that one closely. US 2K 2143, so it hits that 2150 kind of area. I'd like to see a bid here from the US 2K. Not too bad, actually, from this market. It's holding up better than you would expect. The US 30 as well, holding up really nicely, close to all-time highs. It's not a broad-based sell-off. It's basically an attack on technology and an attack on AI stocks in particular. And you can tell that based on RSP. Yeah, it's sold, but it's not even back to the daily 20 moving average here, which sits at 172. So I wouldn't say it's like a freak out in the markets at this point. The Qs hit a gap fill. Could they hit the second gap fill? This is certainly a much weaker market. I think it has structurally changed though by taking this high. So again, I'm believing at this stage, pullbacks will probably be met by bull demand. We hit one of the first key levels. I'd actually like to see it hit 450. Will we get it? Maybe. And of course, if you take a fib from the low to high here, this is of course the Qs. So I'd use the futures market, but this will be, a very key zone for it. So 450 to be watched. NASDAQ much weaker than the rest of the market. S&P, the most important chart. Then we come over to Bitcoin. Well, it's oversold again. And I mean, it's pretty heavily oversold. You can see here, I've got a bit of a signal showing that there is an oversell. That doesn't mean, instantly go buy Bitcoin. Let's go. Party time, moon boys and everything and girls. Well, I don't think it's like that yet. Of course, we do have an alert here at 60,000 to breach and get close above. That's going to be such a pivotal point. I'm excited for the Bitcoin chart. I actually think it's not bad value. And you might say, what the hell value is it? Well, I think it's not too bad when you consider what gold's been doing and how Bitcoin should theoretically react in this weird time of us beating inflation. But as you'll see, we haven't really beaten inflation when we look at our next video that I've got some charts for. I couldn't put them in today, too much to go through. But we are still in what's called a technical lower high. So basically, we have made a high, a lower high, a lower high, and we're currently on a lower high. Until it really reclaims 68.2, we do know that we're still in a downward trend. That's from a technical basis. This actually looks like rubbish when you look at it on a chart at this stage, but there could be still some good signs. So again, what I say is patience and the reaction to the markets, and we'll see some nice, hopefully, breaks, and that could be a very good start for Bitcoin. If you know your stuff about Bitcoin, you would know September absolutely sucks for the crypto, and notoriously it comes back in October, November. Will it be the same this year? I'll bring you the seasonal data in the next video. For the week ahead, what have we got? A little bit. JOLTS job openings, some stuff coming in from the rest of the world. ADP non-farm employment change usually wouldn't move the market that much. ISM services PMI could be important, but of course the big one's going to be on Friday. The fake market non-farm employment change. And I am allowed to say that, and so are you, because you know what? It's a complete crap number. It always has been crap ever since I got into the industry. It's always wrong. It's always revised. And of course, this time's no different. Let's have a look at the revisions 2 months back and see what they've been doing with the jobs numbers. Put it in down below. Do you think it's going to be revised up or down? I think the guess is probably going to be down. If you enjoyed today's video, make sure to subscribe, guys. Watch for the next one. This is an exciting time in markets. Of course, September is the worst month of the year. We know that. Check out our other videos to have a look. But we've got to remain, vigilant on what's really going on. And remember, that liquidity chart is currently still on the flow up. And we know that central banks, they'll always do whatever it takes to try to stop a market going down. Remember, if they're panicking though, you got to go hide under the desk. All right, catch you for now. See you guys.